Hi, and welcome to this month's Trade Floor Update. Today I'm joined by Rob Mead, PIMCO's co-head of Asia Pacific Portfolio Management. Welcome, Rob. Rob, last week the Federal Reserve revealed it would be making some changes to its monetary framework to tolerate a modest offshoot of its 2% inflation target over time. What does this mean for clients and portfolios?
The ongoing adjustments to central bank policy settings, and obviously including by the Fed, are more a reflection of the economy still needing significant monetary support. Obviously, we're in recession in various parts of the world, including in Australia, and all of that means that policy rates are going to stay even lower for longer. And I guess this implies that the inflation rate is also going to be below the 2% target for even longer than hoped. Otherwise, this sort of policy tweak wouldn't be necessary. So for clients and portfolios, what this really means is that inflation is unlikely to be an issue for a number of years. So staying invested in that 5 to 7 year part of the yield curve and rolling down to those anchors that central banks are establishing makes sense. We think the US yield curve is likely to steepen. It's steepened post Jackson Hole, and we think it will stay relatively steep. As we all know, central banking is a relative game. So what this means is that if the Fed is more accommodative than the RBA, then all things equal, there's likely to be further upward pressure on the Australian dollar, which is clearly not optimal as we officially plunge into recession. And higher inflation break-evens mean that longer dated index-linked bonds that are not pricing this sort of environment right now, like Aussie linkers, will provide some additional inflation protection over time.
We've seen the major banks and other companies slash dividends even further this reporting season. Knowing that many Australians rely on these dividend payments for income, can fixed income offer an alternative for those investors?
With Australia having officially moved into recession territory for the first time in literally 114 quarters, almost 30 years, we think this low rate world is going to be with us for a much, much longer period of time. So again, investors should be preparing themselves for this reality. And I think one of the things to think about is how reliable your income stream will be in this environment. And when we look at some of the traditional sources of retirement income, they've been experiencing some pressure. So if we take rental yields, rent relief, moratoriums on evictions, etc., means that those yields are not as reliable. Dividend yields, as we know, some dividends have been cancelled, many have been reduced, again, so nowhere near as reliable. And finally, term deposit rates. Banks don't need the funding as their balance sheets have been shrinking in some cases, or at least not growing. And the RBA has just extended the term and the size of their facility, which provides very cheap funding for the banks. So don't expect term deposit rates to be heading north anytime soon. An alternative source of income would be the corporate bond market and RMBS markets, especially the high quality sectors. Just in the last month since we updated on the trade floor update, issuers like Horizon, CBA, ANZ, IAG, Qantas, Goodman, and Coles have all issued into the local bond market. So these are providing great alternatives for investors to think about in terms of sourcing their income.
Rob, given the quick snapback in equity valuations and credit spreads over the past 2 to 3 months, how are we viewing the relative valuations in credit versus equities currently?
As we just mentioned, given the increased uncertainty about dividends, plus this relative snapback in valuation of equities versus credit, we definitely see the value in the credit market. In terms of how to invest though, we believe now's the right time to buy some of the high quality corporate and structured credit like RMBS. And further down the credit curve, we'd recommend deploying capital more gradually into things like distressed credit or lower rated credit. As we mentioned before, we think this recessionary environment will last for a long time. So these opportunities will continue to present themselves over the next 1 to 3 years.
Thank you for your insights, Rob.
Many thanks, and I look forward to discussing our views in more details with you all very soon. Thank you.
And thank you to our clients for listening. I hope you're staying safe and well. And if you have any additional questions, please feel free to reach out to your local PIMCO account manager.